Welcome to the Radical Middle Podcast, where we believe the right solutions start with asking the right questions. With your host, Thomas McMurtry.
Hi there. Welcome to the Radical Middle Podcast. I'm Thomas McMurtry. I'm joined here by my dear friends, Ian Hull. We've got episode 5 here of our series on real estate and the Canadian economy. Hey, Ian, how are you doing today?
I'm great, Thomas. Nice to see you.
Pleasure as always.
Okay, so we've talked about how banks create money when they issue loans and so on. So let's start there. If modern money is mostly created by the private banks as credit, as we described historically, and that's where the vast majority of the new money is actually gone over the last 20, 30 years, right? So
Correct.
Why does so much of it end up in housing rather than other productive businesses? Like, what is it is it just the simplicity, or is it laziness? Like, what is it that's driving that so foundationally?
Yeah, so this is a key part of our premise here, the creation of credit. And we touched on it, of course, in the last couple episodes, and you alluded to, I think it was our last episode where you spoke about tier 1 and tier 2 capital. So you're referring to the Basel regulations, which have been updated a few times, the most recent being Basel III. But not to get into the minutia, what the reason that there's a bias, I would say, towards bank lending for existing assets and particularly real estate is multifaceted, but it's obvious at its face value because risk-weighted assets are a big part of that capital assessment for capital requirements. So when you're loaning against a house or existing real estate, that asset just the risk is so low, of course, for banks. It's incentive-wise, it's a no-brainer, of course. It's much less risky than lending for a business or a productive enterprise. But there's also a strong institutional bias, right? So, of course, you're familiar with mortgage-backed securities and the securitization, and most people think of that in the 2008 crisis, or maybe Margaret Robbie explaining it in a bathtub in that movie, The Big Short. She was, I think, talking about credit default swaps. But in Canada, we have the same program, right? Through the CMHC, Canadian Mortgage and Housing Corporation, and also our Canadian Mortgage Bonds program. We've sort of also encouraged banks to further lend against real estate, because when you securitize those loans, you take them off your books in essence. So, and at the same time, we're also insuring a large portion of that. So about 50% of Canadian mortgages are insured either by the government directly or by private insurers that are essentially guaranteed by the government. So,
right. So, but just on that point though, Thomas, is CMHC a good thing or a bad thing?
Well, that's a fascinating question, So we don't have counterfactuals here. I would say encouraging a huge increase in private debt is potentially unstable and not. That's kind of what the premise here is, that it's not a sustainable long-term strategy. And they could have had the best of intentions here. I wrote down a couple questions, and I don't have the answers to all of these, but have we succeeded in democratizing housing, right? They have the most noble aims. Let's make it easier for people to buy housing. And the origins of CMHC go back to post-World War II, National Housing Act, I believe, where it was always intended to get lower income households the more ability to buy, but it usually worked better for middle to higher income households in the end, having more easy flowing credit. So the question is, we don't have the counterfactual, right? Land is always going to be a scarce resource, right? But would housing have taken off at such a rate as it has without the availability of cheap credit and 30-year mortgages and low interest rates as well?
So there's a theory right now in Canada, the federal government and provincial governments are now sort of giving breaks to encourage housing. The feds, I think, just brought in the $3 billion amount to encourage it, and the Ontario government's taking the HST off. You can see where that would help, this whole idea of development costs and so on. But it seems to me that it's a bigger problem. Like, you can't necessarily throw, which is big money, but not really big money, at a big problem, right? Like, we're throwing all of this money into it from the government level, but you still have to incentivize building and builders to get in. and the scarcity of the land drives the pricing. And it seems to me that the CMHC is a great tool to help encourage the home buyers as well. It's another many billion-dollar plan. But the idea that we built an economy up without a tie to sort of entrepreneurial drive and so on seems to be a big problem here, because these builders, I'm not sure this is going to work. Throwing a few $billion at a stagnant growth seems to me to be a real sort of just a Band-Aid.
Yeah. Yeah, that's something I thought of this morning as well too, Ian. It's kind of coming at things from two angles that are butting heads, right? So we're simultaneously, first of all, the banks are encouraged to lend more, to keep the rates down, and print more money to buy existing assets. Simultaneously, and the government's trying to encourage home building. Simultaneously, we have these more and more taxes on development, and ways that inhibit new production of housing. So it seems the only result will be an increase of bidding up the price of existing housing. So those are big questions. And I don't think that providing more and more leveraged households, more and more easy loan terms is the solution, right? I think that the houses are going to keep going up, but that's really more of what my focus was as well, to your point on sort of a stagflationary environment here, right? How is this impacting our ability to do business? And that's really what the crux of my thesis was on does this crowd out lending for business? But there's other factors that would also impact business investment that we can get into.
Well, so tell me a little bit about the crowding part, because that's such a good point, isn't it? Like there are other factors. It's not just about the residential real estate lending market.
Yeah, exactly. There's papers that corroborate this on a macro scale, that this allocation to credit biasing real estate has long-term implications, negative implications specifically for GDP growth. And I'll link some of these papers in our show notes, but we don't get too nitty-gritty. There's also a microeconomic paper from the States by Chakrabarty et al. And his other authors, but it was in 2018. But they were doing an example specifically on the crowding out hypothesis in individual states in the United States and individual banks. When there's an uptick in real estate prices, they saw a decrease in lending specifically for business, for business loans. So that was the sort of micro factors that sort of proved that at least on a micro scale in the United States. My research was more on a macro scale, but that idea is basically that banks, while they can create money, we know they're still capitally constrained somewhat. And so therefore, printing money for housing is very easy to stay within the capital requirements. But the idea is that you still have a finite amount of capital, let's say, so to speak. And it's much easier, and the returns are much higher even on real estate, at least in the last 20, 30 years. So the idea is, the simple idea in the bank level is that there's no reason to take risky loans on business or fund entrepreneurs when there's easy returns that are much less risky on the other side of the balance sheet.
And that U.S. study is really interesting. I know it's 2018, but that's still pretty current to exactly what's been going on in the last 10 years, really, in terms of the lending community. All right, and so once you've got your head around the problem, I know in episode 6 we're going to sort of wrap up your thesis and get a better understanding of some of the look forward plan. But what are other elements that are sort of driving this downward trend as opposed to upward trend on the GDP that we could sort of look to the banking industry as part of the problem?
Yeah. So then it's the spillover effects from the banking industry, right? And so we're not just stagnating GDP growth, but also we've had a huge decline in productivity that we spoke on the last episode. And that's a big topic in Canada, and declining business investment or stagnating business investment. And I think those are the issues that spill out from bank policy. So I think that's why I think these questions are paramount, to look at the monetary policy and potentially fiscal as well. But how does that spill out into the wider economy? And it's quite logical if you look around, but you think if the cost of real estate is just keep climbing higher and higher, the cost of doing business is going up. So, ironically, we're more awash with wealth, but we're poorer in essence, right? So that's sort of, they speak of the hidden tax of inflation. So if real estate prices go way up, they're inflating, we're actually somewhat poorer as a result. And so if you want to start a business, whether it's a mom and pop shop, we spoke about small businesses are the backbone of the economy. So you're just looking at really high costs up front just to maintain your rent. And then that spills over to labor, right? So there's a famous quote. We go back to some of the political economists. There's a classic economist named David Ricardo, who was in the 19th century. He was a banker representing the bankers in Parliament. But he said the landlord's interests are always opposed to every other class in society. Now, ironically, they've partnered with the bankers, as we've talked about. So they're not necessarily antagonistic with the bankers now, but that was the idea that they're just going to keep swallowing up rents. And so your labor costs more. You have to pay your employees more to live in these big cities, New York, Toronto. It's still not enough, London. And so it makes it more stressful. And we've touched on this briefly, but yeah, to be an entrepreneur, it's hard when you're unless you're really wealthy to begin with, to start a business when you're really just struggling to put food on the table, and those costs just keep climbing. Not just the real estate cost, but the debt service as well, which is a climbing bill in households as well as governments right now.
Wow. Okay. Well, it seems to me obviously we understand what the banking and the lending to residential real estate is doing, and the ripple effect of what it's doing, and then also the impact on business generally. So it's interesting to see how it unfolds as we hit now in Canada for the first time in a long time. We have a prime minister who's an economist and speaks your language. So I'm hoping in briefing meetings he's pushing back on some of these ideas and sort of trying to talk about changes to the monetary policies that might help drive this. But that leads us to our final episode, which we're going to be finishing off rounding off your thesis and summarizing where we're at. So today, I think we've got lots to think about in terms of the economy and where we're going. And I don't have any further questions unless you want to add anything else on this episode.
No, I think we covered most of it. I think, will be an exciting last episode where we'll point to, can we try and change these institutional biases in a different direction? So hopefully our dear Prime Minister Carney is thinking of the same things. But I think we might need innovative solutions. That's where the radical middle, we hope we can shine here with asking the right questions, right? That starts with the challenging our basic assumptions about what is going to work actually to get the Canadian economy going again, I guess, Ian.
Awesome. All right. Well, great to see you, Thomas, and we'll see you again soon.
Look forward to it. Thanks, Ian.
Thank you for listening to the Radical Middle Podcast. Check out our show notes for further reading. For any inquiries, reach out at theradicalmiddlemedia@gmail.com.